Good morning, everyone. And I'm so sorry we had a few-minute delay and some of you had trouble getting on, but we sent out a new link, although if you're on, you've already figured it out. So apologies to everyone for having to wait a few minutes. Hi, I'm Senator Liz Krueger, and I'm welcoming all of you who are with us today on Zoom or Facebook, or who are calling in into the third session of the 2024 Older Adults Roundtable series. This morning's program is titled The Power of Investing, Stocks and Bonds and Managing Risk. As always, we have closed captioning for today's event. And as a viewer, you have to activate closed captioning in order to view the text. So if you're on Zoom, you click on live transcript in the meeting controls to start viewing closed captioning. And if you're on Facebook Live, you'll see a setting button in the bottom right-hand corner of the video, and you click on CC for closed captioning to activate the process. This forum is being recorded, and everyone who RSVP'd will receive an email with a link to the event video and the resources that are being posted in the chat within a few days, along with the presenters' PowerPoint. So we always remind everyone, even though you're getting a huge amount of information from our experts, don't think you have to take a pen and try to scribble everything down, because we'll be sending you everything and you can re-watch this whenever you wish, or you can share it with others who you think might find it helpful, who might not have been able to attend this morning. So, overview. The average older person has a limited amount of money to invest to support their retirement. We know that. And in order to safeguard your assets, it's important to understand the basic types of investments you can choose to make and how to manage the associated risk, because there is risk associated with all kinds of investments. It's also important to understand when you need a professional to help you with your investments and what you should expect from them. Today, we have two wonderful presenters for our roundtable that is titled Promoting Your Financial Security, The Power of Investing in Stocks and Bonds and Managing Risk. We've had both of our guests on before, so I can vouch for how valuable their information is. We'll be hearing from Erin Slocum, a certified financial planner, who's the president of the Financial Planning Association of Metro New York, and also Edward Hadad, who's also a certified financial planner and a board member of the Financial Planning Association. Again, we're not necessarily suggesting anyone should be hiring Erin or Ed. They've actually volunteered to come on to help us all understand, because they represent an association of people who do this work and who are recognized as certified to do this work. And they will no doubt explain a little bit about someone who says that they are a professional in this field versus being actually certified as a financial planner. After their presentation, I'll be moderating a Q&A where many people have already submitted excellent questions. I'm afraid probably a little more than we will even have time for. But as usual, if you are listening and you have other questions, you are more than welcome to type them in and we will try to squeeze them in. Or it's possible we already have a very similar question in queue to be asked. With that, I would now like to turn it over to Erin and Ed to make their presentation, and then I'll come back for the Q&A. Good morning, Erin and Ed. Thank you so much. And sorry it took us a little time to get ourselves organized today.
Thanks so much for having us, Senator Krueger, and thanks to your wonderful staff and your constituents who have so many good questions lined up. So my name's Ed Hadad. I'm going to pass it over to Erin. Going to start us off and introduce herself too.
Hi, everyone. And yes, thanks again for having us. Ed and we had a good time doing this last year. So yeah, welcome. My name is Erin, and as Senator Krueger said, I'm the president of the Metro New York chapter of the Financial Planning Association, and I am a certified financial planner. And yeah, Ed and I are happy to be here. I think, so we'll just get started. Everyone should see my screen. So I just wanted to start off by covering some types of financial professionals you might encounter on an internet search, or when you're researching who to work with, what type of advisor. So these are some of the common ones, and I want to start out by saying that titles might mean nothing. As Senator Krueger alluded to, calling oneself a financial advisor or a planner doesn't mean they have the training, credentials, or any registrations. So you do want to make sure you've done your due diligence before engaging with the professional. So getting a little ahead of myself here. There are, like I said, many different kinds. And again, some of the ones you'll run or come across. A personal banker, many people use their personal banker as their quote unquote financial advisor. These professionals typically advise clients on their finances by recommending financial products and services such as retirement accounts, savings accounts, and they can also oversee bank accounts and transactions. They can also provide lending solutions like loans, mortgages. It's definitely more product focused, not holistic, and probably likely have limited financial planning knowledge. The next type is someone, whether it's an individual or a firm, that's a broker dealer. So these are typically like your wirehouses, for example, the Morgan Stanleys, Merrill Lynch, JP Morgan, UBS, also some regional brokers. And these can be individuals or companies that buy and sell securities on behalf of their clients, and the types of products they can offer depend on their licenses. So while they might have extensive market knowledge and lots of investment options, they tend to be product and transaction focused because their compensation is commission-based. And this could lead to conflicts of interest, meaning that these individuals or firms might not act in their clients' best interests. And they're probably not providing comprehensive financial planning either. Another common one, an insurance agent. As the name suggests, they are licensed to sell insurance products, life insurance policies, annuities. They have expertise in these types of products and risk management and protection. But like the broker dealers, they are commission based as well. And again, there's that potential for conflicts of interest. And again, probably don't do comprehensive planning. A certified public accountant, CPA, they really specialize in taxes, and they're not typically trained or experienced in comprehensive financial planning. Although there are some financial planners who are CPAs as well. So they could be both, but of course, when you're looking to work with a professional, you find a CPA, you would want to also just make sure that they're, if you need financial planning services, that they can help you there as well. And then certified financial planner. This is what both Ed and I designation we both have. Generally, CFPs offer comprehensive financial planning, including retirement, investment, taxes, estate, and insurance planning. Now, we're not necessarily experts in each of those fields. Again, it depends on focus, but certainly there's a broad knowledge of these different elements and how they, fit into one's overall financial planning, which we'll talk about in a moment. And so for a professional to use the CFP letters, they have had to have met rigorous education and experience requirements, and also passed an exam. And they have a fiduciary responsibility to act in their client's best interest. So Ed will talk a little bit more about this, but I will move on. So questions to ask when choosing or looking for an advisor. Are you a fiduciary? This is the most important. A fiduciary is someone, like I said, will act, they are legally obligated to act in their client's best interests, to put their interests, the client's interests, ahead of their own. What types of services do you offer? So some professionals offer a wide range, while others specialize in specific areas of wealth management. Some may handle only investments, while others take a more comprehensive approach, such as, again, that retirement, maybe more of an estate planning lens, in addition to investments. So you should look for an advisor whose range of services best fit your current and your future needs. It's also helpful to know if they specialize in a specific type of client, such as retirees, or some also maybe work mainly with divorcees. Just a couple of examples there. What is your investment approach? Is what types of solutions or products do they have access to? If you're going to need help with your investments and implementing an investment plan. There's also a type of relationship called discretionary versus non-discretionary. When it's a discretionary relationship, you are essentially giving this person full control over your investments. Now, of course, there should be dialogue and an investment policy statement. There's lots of different elements to this, but generally you are giving them kind of full control, if you will, of the investments, versus non-discretionary, where you're typically having to approve trades or certain solutions. So, and sometimes there can be a hybrid approach there as well. And then how are you paid? What are your fees? So this is really important. When I mentioned in the last slide about what's their compensation? Is it commission based? Is it fee only? And that'll give you a sense of the potential likelihood for those conflicts of interest, and Ed will get more in depth now.
Thanks, Erin. I'll take over for a few minutes, and this slide is a little bit in a response to some of the questions we got last year. Like, what if you were to engage in a financial advisor? And we're going to get to investments in a second, but there's a lot of questions about, well, say I wanted to get help. What are some of the expectations? Starting with costs, and these can really be, I'd say, all over the map, but the fees can be from 0.5% up to 1.5%. Usually averaging around 1% of your financial assets. So say you had $500,000 to invest, you would easily expect a fee of about $5,000 a year. $1 million, that could be more like $10,000, but it could range from up to 5 to maybe even 15, and kind of anything in between. On the lower end, sometimes it's a little bit higher. The more assets you have, usually the fees start to tier down. As Erin alluded to, there's multiple ways of compensation. So most ways are, if you have a portfolio, it can get charged, that your services are charged on an ongoing basis. However, there are planners out there and other professionals who may work on an hourly basis. There's some who work on a project basis. Those are rare, but we'll include a link at the end. And there are certain planners out there who do work for those kind of smaller engagements if you want to look for something like that. If you're looking, this is just to educate you on what the world is out there, what you can expect, what different services are available. But as Erin said, one of the kind of hallmarks is that you should know and be comfortable with how your advisor is compensated. So are they actually offering comprehensive financial planning, covering all facets of your financial plan, which we're going to get to more in a second, or are they just doing investments? Or are they just kind of covering insurance? So know what they are offering, how they are compensated, and the totality of those services. So as Senator Krueger and Erin talked about, we are both certified financial planners. We're a little biased. We think if you're engaging in financial planning, you should engage a CFP. And some of the duties owed to clients by a CFP I have down here is fiduciary, best interest, put your best interest at all times, integrity, competence. Are you a subject matter expert? If you're getting into an area where you're not an expert, a CFP needs to engage someone who can, or work within their own firm, or say you don't know and devise a plan. Diligence, always disclosing conflicts of interest. which may not be a problem. You may be recommending a certain investment, and who knows, maybe a spouse works at that company. It doesn't mean it's bad, but these sort of things should be disclosed. Your due, sound, and objective professional judgment, of course, professionalism, compliance, and confidentiality. So those are just some. There's actually more, but just giving you kind of a taste of what you should expect. So if you're engaging in financial planning, we would say look for a CFP, then get a better idea of what are all the services offered by the firm and the engagement. Okay, next slide, please. Okay, so financial plan. So we keep saying comprehensive financial plan. So what does that mean? We're here to talk about investments today, but we do want to stress that you can't just look at investments in isolation. What are those investments doing for you? What are your goals? What's your current cash flow? Do you have an emergency fund? Are you in retirement? Are you getting ready for retirement? What's your insurance picture look like? Do you have proper, maybe you need long-term care. Do you still need life insurance, health insurance, property insurance, liability insurance, perhaps education funding, depending on where you are in your life, or there may be grandkids. Taxes play a very, very important role. If you're still working, are you optimizing benefits? What are your liabilities? Do you have a mortgage? Do you have other liabilities? And your estate planning, making sure that's in order. So when we say a comprehensive financial plan, we want to make sure all of these components are kind of working together for you in your best interest for your goals. So you can't just say, I'm here to invest my money, but what about all these other components? So it's important not to just think of investments in isolation, but how are all these components working together? Okay, next slide, please. Okay, some of the basics of different investment accounts. Now we're simplifying a little bit here, but a brokerage account is a typical investment account anybody can open. Money can go in and out freely. You can buy stocks and bonds and mutual funds and ETFs. We'll get into those in a second. If an investment is held less than 1 year, it's taxed at short-term capital gains, which is basically the regular income taxes. If you hold something more than a year, you get an advantage, and it gets taxed at a long-term capital gains rate, which could be 0, 15, or 20. So that's a typical brokerage account. Anybody can open it any point in your life. There's not many restrictions. Money can go in and out. A traditional IRA or 401k or 403b, and there are others, is a retirement account. So some of you may have these, or you're already contributing to these. Money in these accounts is going in pre-tax. So you're working, you're not taxed on that money. It goes in there, it gets to grow for years and years and years. And then at a certain point, you want to start taking that out to live on retirement or for other reasons. So you can't take it out before age 59 and a half without penalty. There's a 10% penalty. There's a couple exceptions for couple cases. You may be able to take loans, but in general, you need to wait till you're 59 and a half. But you don't have to take it off. At 73, currently, that age will raise in future decades, but at age 73, you have to start taking what is called required minimum distribution. So the money was not taxed on the way in, but now it's going to get taxed on the way out. So it's been able to grow tax-free this whole time. Now you're taking it out as income. This is now income. It's not taxed at capital gains, but it's going to be taxed at whatever income level you have. It's going to be combined with Social Security, perhaps pension, any other income you may have. That's all together, and it's going to get taxed at the income tax tables. As opposed to a Roth. So a Roth is a similar type of account, but that money goes in after it's already been taxed. So you probably have heard about these. There's a Roth IRA. There's now also Roth 401ks. So you pay the tax up front, that goes in, and that just gets to grow for as long as you want. And there are no RMDs. You still have to wait to 59 and a half to take out the earnings. You can take out some of the contributions. There's a couple other stipulations about waiting 5 years, but those are the main differences. Traditional IRA 401k goes in pre-tax, you're paying tax at the end. A Roth, you're paying tax up front, and you get to take the money out tax-free. And it's a little bit more flexible. Okay, next slide, please. Okay. Fundamentals of some of the investments. So questions to ask yourself. what do I want this money to do for me? So is this for income? Is this for a future need that may be 10, 20, 30 years down the road? Is this an emergency fund? Do I need to have access to this money within 2 weeks? Or is it for wealth accumulation? Perhaps I already have a stable income or retirement income from other sources. Is this something I want to leave a legacy? Is this something I want to leave to kids or grandkids or perhaps a charity? So this can affect your mindset and the approach of how you're going to invest. Start to think about some of these questions. Not just, I've got money, let's invest. In relation to that, how much money do you have to invest? Will I need this in a short amount of time? Can I quantify or start talking about goals? Do I know exactly what I need? Do I need $50,000 a year starting in 10 years? Can we start to math this out? And then what is my risk tolerance and comfort level? So we hear this word risk all the time, but what does that mean? So let's get into what we define as risk a little bit. So mainly when we're talking about investments, risk is often translated to this word called volatility. I'm sure you've heard that on the news, especially in the last few days. You saw what happened yesterday in the markets. It looks like we're recovering a little bit today. Volatility means the variation in price. And so different financial products, so stocks versus bond, they have different levels of risk in general. And Erin will talk about it a little bit later. Stocks are more volatile than bonds most years. So we have here, people take a higher risk with the expectation of getting a higher return. So you might get a higher reward, but of course that's not guaranteed. There's also a risk that you won't get that expected return. So when thinking about an investment plan, there are different questionnaires you can take to kind of gauge what your level of risk is. It also has to do with some of those questions we asked before. What's your time frame? What are your goals? Someone who's 20 can actually afford to take a lot more risk than perhaps someone who's 70. And some of the exercises you may go through is, okay, if you have $1,000 investment, can you tolerate that going to 1,200, up 200? Sure, anyone could do that. That feels great. But what about if you had $1,000 investment and we hit a period like COVID or perhaps 2008, and that goes down to $650? Would you be able to sleep at night? Would that adversely affect your immediate goals going forward? So you need to kind of discover your own personal tolerance for risk. And there's a number of ways of doing that. But I guess the best way is if you're working with a professional to really get on the same page with what your kind of risk tolerance is. Next slide, please. So we talked about market risk. That's kind of the fluctuation of certain investments. There's other types of risk, but you just should be aware of. There's inflation risk. So that's not something we worried about for quite some time until the last couple of years, where a loss of purchasing power. So if you have all your money in cash, say that's earning 4%, but inflation's 5%, you're actually losing money each year. You think you're being safe, but there's inflation risk. So there's a loss of purchasing power. There's something called interest rate risk. So depending upon rates falling or increasing, that can affect bond prices, which Erin will talk about a little bit. There's something called liquidity risk. Are you able to sell this asset? So most stocks and bonds and things we're talking about in this presentation are quite liquid, meaning you can convert that and sell it and get your money within a fairly short amount of time. If you're investing in things like private investments or you're buying an apartment building, that is not liquid. If you're going to need that money on a short-term basis, or even within a couple of years, you have to determine up front, am I going to need this money? I shouldn't be investing in an apartment building that may take 5 years to sell if I'm going to need this in 3 years. There's other things like currency risk, which means if you're investing in other countries, the value of that currency can fluctuate versus the dollar, and you can end up losing money even if the investment made money in that country. And then there's also things like concentration risk. So we're going to talk about diversification, but concentration risk means having too many investments or too many of your resources in too few investments. You have the opportunity for outsized gain, but you're taking a lot of risk for loss as well. So that's a little bit of a primer on risk and all the components of that. Next slide, please. When developing an investment plan, we touched on it so earlier, but also your time horizon. So here are just some rules of thumb. These are not hard and fast, but some things just to think about. A short-term goal. What we consider short-term is probably 3 years and under. If you know you're going to need that money for something 3 years and under, in most cases, we're going to recommend keeping that in cash or a CD or a money market. You don't want to have that riding in stocks and bonds when you know you may be having some type of purchase or something with under about 3 years. Intermediate goals, you're getting out there a little bit, 3 to 8 years. There you can afford to probably take some more risk. You might have a larger part in bonds, but keep in mind that what is this money going to be needed for, and like what is my time frame? And then longer term goals, we say about 8+ years here. Again, these are not like set in stone, but this is where you can really afford to take more risk in most cases, and in a well-diversified portfolio. So you can have a little bit more in stocks, and we'll get into more in asset allocation in a minute. But we want you to think not just what are the investments I can use, but also what are those time horizons. At this point, I think I'd kick it back to you, Erin.
So now we're going to get into the actual types of investment. So you can see here, there's in kind of in our world, we say like there's 4 main asset classes: cash and cash equivalents, bonds, also kind of formerly known as fixed income, stocks or equities, and then alternative investments. So alternative investments could be what cryptocurrency or private investments, commodities, gold, just a few examples. When you invest, you're dividing your money over different asset classes depending on your goals and time horizon. So each bucket serves a purpose in your portfolio, and this is called asset allocation, and we'll talk about that in a few minutes. We will do a deeper dive on stocks and bonds, but just to quickly high level talk about each one of these. Cash and cash equivalents, your main goal is stability. You probably won't lose money with these investments, but you won't gain much either. So the main risk with staying in cash or very short term, what we call cash equivalents, is the rate at which you earn money could be lower than the rate of inflation. So that inflation risk that Ed just talked about. So these are really best for your short-term goals and cash needs, an emergency fund, for example. There are things such as checking and savings accounts, certificate of deposits, money market funds, and very short-term US Treasury bills. Bonds, so fixed income, essentially you are loaning money to an entity, whether it's a government or a company. An investor who's looking to get a stream of income might allocate more to bonds, and or one looking to offset the larger risk, let's say, of their stock portfolio. So essentially here you're, again, generally receiving a moderate return in exchange for a moderate amount of risk. In contrast with stocks, you are buying a piece of a company. So the main goal here is growth. An investor looking for a larger return, although with that does come a larger amount of risk. But again, if you do have a longer term time horizon, such as you're years and years away from retirement, for example, or I'm buying a house in 10 years, that's my goal. It's better to be in these are really the growth engine of any portfolio. So next, so stocks, a share of a company. A lot of stocks a lot of companies pay dividends, not all of them, but that could be a potential source of income in addition to your bonds and things like that. There are different types of stocks, so we call these sub asset classes. Stocks in domestic companies, which from our perspective are those that are based in the US. We all know the Apples, Netflix, Google, right? International, so these are non-US. These could be in developed countries like France, Japan, Germany, or emerging markets like Argentina, China, India. Emerging market stocks tend to be much more risky and volatile than US or even those developed countries. There's just a lot inherent country risk in an emerging market. Capitalization, so there's large, mid, and small cap stocks. There's no like hard and fast rule, but generally a small cap stock is a company that's valued less than $2 billion. Again, those in and of themselves compared to large and mid cap also tend to be a little riskier and have, has a different risk profile than a mid or a large cap stock. A mid cap is typically between 2 to 10 billion, and then large cap over 10 billion. Like I said, we know the Metas and Googles. There's also growth in value. So typically larger, more well-established companies that the market, value are larger, more well-established companies that the market thinks are undervalued. Typically they pay higher dividends. They're relatively stable with low volatility versus their growth peers. And growth companies tend to pay a very low dividend or none at all because they're reinvesting back into their company rather than paying it out to their shareholders. So stock prices can drop for a variety of reasons, including, poor performance. I'm getting ahead of myself. Including poor performance or certain companies, and there's concerns about the economy, just like what happened yesterday. So dips in the stock market tend to be worse than in the bond market, but again, you're expecting to get a higher return. A bond, again, a loan. Essentially, you expect to get paid back after a certain period of time, so the maturity, and until such time, there's usually an interest payment, also called the coupon. Basically, government bonds are a way for the US or local or foreign governments to raise money from the public for certain projects, or pay for schools. Municipal, that's your local government. And then corporations, when they want to raise money, there again, I think there's US and non-US. Investment grade, these are high quality companies, and again, versus their high yield peers called junk bonds, essentially. And I'll show you a chart in a minute that kind of shows the scale of quality. So, high yield bonds, they are riskier, but you do expect to get a higher return, even just within the bond space. And then just taking a step back on treasuries, treasury bills have a maturity less than 1 year. So these are typically what we call and think of as cash and cash equivalents. There's treasury notes that come in maturities of 2, 3, 5, 7, and 10 years. And then a treasury bond is a treasury bond that matures in over 10 years. So, just like there's different characteristics of stocks that that I kind of talked about high level, there's even within bonds themselves, there's a lot of many considerations, right? So what is the interest? What is that coupon payment, right? What am I getting paid? What's the maturity date? So the date that the loan is due to be paid back. I mentioned that short-term, intermediate, and long-term. If you're loaning money for the longer term, you would expect that you get a higher coupon payment, right? Because you are going to be waiting much longer to get that money back, as an example. Shorter term instruments, typically they're very low interest interest payments. But again, it's a lot of even the coupon depends on what overarching rates are in existing rates, right? We all have heard about the Federal Reserve and how they've been keeping rates now higher for longer, but we were in a very long period of incredibly low interest rates. What is the quality? And this is what I was talking about, high yield versus investment grade. And there's this little chart on the right-hand side where you can see, obviously the higher quality is the lowest risk, but you're not getting paid as much. And that could be okay, if you need this money for, to be your kind of your sleep at night money. And then taxes. So when you invest in a US Treasury, there's no state or local tax on interest. You do have to pay federal interest. Municipal bonds, there's no federal, state, or local tax on the interest if you're investing in your own state. So if I'm a New York City resident and I buy a New York City bond, on that interest payment, I'm not paying any New York state or city tax. And then corporate and sovereign bonds, so foreign bonds, interest is taxed at your interest rate. So there's no federal or state local exclusion there on interest. So I just wanted to show this visual. This is from 1928 to 2022. To use this as a visual to show what we mean by saying that stocks are riskier. You can see here on this chart that stocks here on the far left have a wider range of returns. So on the high end, over 52%. But when you look on the low end, negative 43%. And on average, stocks, little over almost 10%. But you can see that they're much more volatile, meaning the range of returns is greater. When we talked here on the far right, this is cash, the 14%, 3%, and 0%. Again, this is what we mean by this is purchasing power, loss of purchasing power. And even just, so if you're just starting out, in your career and you've only been sitting in cash, you're likely going to have over time actually lost money or lose money if you just stayed in cash. So, inflation has averaged during this time frame a little more than 3%. So I guess that would equate to real annual returns of, stocks at 6.5%, bonds 1.5%, and then cash basically flat. So how do we invest? Ed talked about the types of accounts. Let's talk, I guess, about products or vehicles in which you can invest to implement your plan. So there are things called individual stocks and bonds. So you can buy a share of Apple. You can buy a US Treasury bill. There's mutual funds. So there's two main kinds, and similar as well for ETFs, but for mutual funds, there's managed, which are more active, and then passive, which are like really just tracking an index. Passive is certainly the most cost effective because the fees are typically lower. You're not paying a fund manager higher, for professional management. They're carefully tracking the underlying investments. They're making adjustments to the asset allocation or even the makeup of the fund itself, the different, the underlying stocks or bonds, based on their best thinking. So that's why they managed active funds are typically more expensive. There are cases, I would say, like where it is worth it to pay more. So for example, emerging markets, they're very specialized. There's lots of nuances, right? If you're investing in Chinese companies within India, for example, but asset classes where there are already efficiencies, like, US large and mid cap space, it doesn't generally pay to be active. That manager has to be hitting it out of the park for for it to be worth it. But I just wanted to kind of highlight the difference there. And there were some links, I use Morningstar a lot. They show what the fees are and various performance metrics over the years. So that's just something, a resource that we had a link to in the materials. And then ETFs are similar to mutual funds. There's a few differences, but these are generally like, passive, very like low cost. This slide, I'm not going to spend too much, or really much time at all, because I want to get to, we want to get through the rest of the material, but this is just highlighting some of the differences and similarities between mutual funds and ETFs. And I think the main thing I will highlight for either one, you're getting instant diversification. So you're not going to have, a concentrated position if you're just like owning, Apple, right? In order to get immediate diversification, you'd have to buy lots of individual stocks and bonds, but whereas a mutual fund or an ETF, it's buying one fund and then you have instant diversification there. All right, back to Ed.
Thanks, Erin. So we've said this term a few times, asset allocation, and these are just some examples, okay? These are not rules to live by, but we just want to help kind of put this in context when we're saying taking more risk for maybe more moderate versus more conservative. So a higher risk portfolio might be something in the range of what we call an 80-20. So 80% stocks versus 20% bond and cash, or even more. And typically you're going to see this with someone who's got decades and decades and decades of growth ahead of them. So someone younger, retirement account, I'm not retiring in 30 years. This is probably going to be something more appropriate. Or depending just upon your circumstances and your risk profile, your risk appetite, this could be something for you if you have enough income and you want to try to grow, looking for some type of legacy. But when we say higher risk, we're thinking in these kind of terms. More moderate is something more, might be more in the 60-40 range. If you haven't heard that term, it's pretty common. It's a very common allocation for most people. 60% stocks, 40% bonds. You're bringing that down a little bit, bringing the bonds up, and then going over to more conservative, maybe more in a 40-60. So you're flipping that 40% stocks, 60% bonds, cash. Again, these are not rules to live by. These are just to give kind of context of what we mean by that. And just to put the disclaimers again, the higher the risk, the higher potential gain, but also potential loss. There's no guarantee in these returns, especially over certain time periods. So that is asset allocation. Next slide, please. We've also heard us mention diversification many times. So at my firm, we don't really do individual stocks or bonds. We like to invest in certain indexes with a sprinkling of active management, as Erin said. But diversification means spreading about your investments over a wide array of not only geographies, but size of companies and the number of companies within each kind of class or sub-asset class. So this is a fun chart. Last year I played a little joke on the audience and I said, can you see the pattern here? So can anyone see the pattern? Each color represents a different asset class. This is the last 20 years of returns on asset classes. So if you take a look at it, it's a trick question. There is no pattern. So what we have here is all these different asset classes. You can see in 2023, we have large cap equity, which did very well. Below that was developed markets, not including the US. Then the smaller companies that Erin was talking about. Then it was high yield bonds and emerging companies, some of the companies like China, India, Brazil. Then there's a real estate sector. Then it was global bonds, then US fixed income, then cash. So this chart is just to show you in any given year, you have no idea what's going to perform the best. It's all over the place. And there's lots of different reasons for that. But when we say diversification, it's our personal philosophy that you should be diversified across asset classes and within those asset classes. So you're not putting all your money into large cap US or maybe one country or one type of sector, or even within tech or like oil companies or a couple individual stocks. You may have a sprinkling of these, but it's our philosophy that you should be spread far and wide and then across most of these asset classes. Next slide, please. So we've covered a lot. This is just supposed to be kind of fundamentals, but here are just a couple tips and things to keep in mind that we thought were important. Creating an investment plan with that proper asset allocation to fit your goals and risk tolerance. That's something we've repeated a few times. It's important to diversify and be patient. If you can invest systematically, automation is your friend. Be mindful of fees and expenses. If you're still working, you should participate in your retirement plan and always try to capture the company match. Most companies will have, say, a 3 to 5 to 6% match, which we consider a term free money. They will match a certain level that you're putting in, and at a minimum, you should try to go for that. Couple things just to keep in mind. Mindset. This is more of a personal opinion on our part, but we think good investing should be boring. It shouldn't be something that you're looking at every day. Your portfolio shouldn't be jumping 5, 6, 7%. Your whole portfolio should not be that volatile. Building wealth is a process. It takes time, and it should accumulate over time. Losses are going to occur. It's a necessary part of investing. Try to stay disciplined through those kind of dips and swings. Yesterday was a good example. Some say it's the fee we pay. The reason why investments make money is because there is that volatility. You have to be able to kind of sit through that, and you will be rewarded in the long run. Nobody will consistently beat the market. And for a lot of people, the more you check in on your portfolio, the harder it may be to stay the course. So those are just some general kind of mindset and action and tips we think you should consider when kind of engaging in any of these things. Next slide. And I know the slides will be shared with all the audience members. It's a couple resources we have here. So if you're interested in finding a CFP professional through the CFP board that manages that certification, there's a link here, and you can go through the planner search and look for different planners in Manhattan or wherever you may be in the city. You actually don't need anymore really to work with someone who's near you. We work with clients all over the country, and you may want to find a certain niche like Erin was talking about. Perhaps you want someone who just works with retirees, or maybe with single people, or perhaps dentists, or whatever that may be. There are certain planners who specialize across those kind of niches, so you can look through there if that's something that interests you. There is a link to Investopedia, which is a nice resource that has different terms and concepts. There's articles. Even as a professional, I consult this all the time. We're constantly learning. If you have a question about a certain term or anything, it's a great place to go. Morningstar is a service that rates bonds and mutual funds and ETFs. And if you go in there, you can see they will kind of show you the history of how it's performed, perhaps towards its peers. If someone recommends something, you want to get a little more information on it, that's a good resource. Then we also always recommend Wall Street Journal, the New York Times has great columns, Financial Times, Yahoo Finance. There's lots of resources out there to kind of educate yourself. And I think that's all we've got, right? We want to say thank you. We're both members of the FPA here in Metro New York. We don't work at the same firm. We're colleagues. We're friends. We do education events, pro bono advocacy work. And I think our senator's back with maybe some good questions.
Great. Well, thank you so much, Erin and Ed. I always learn when I listen to you present, so I really appreciate this. And even though we started a little late, you only, I gave you another 10 minutes in the notes, but you didn't even need the whole thing. So thank you. Thank you. So we do have many questions, but any number of them, including that came in during the presentation, are about needing a clarification from you about financial advisor fees. What if you're also a fiduciary? Does that mean you are getting paid both by the client and some kind of commission from companies? Just explain this all to us so we understand what the deal we might be walking into is.
You want to take
Oh,
that,
you
Erin?
went.
Okay. Okay, so fiduciary is someone who is supposed to act in your best interests at all times. And you can simply ask, if it's unclear, whoever you're working with, are you a fiduciary? It's even hard for us to follow sometimes, who's acting under what guidance. If perhaps you work for an insurance company and you sell insurance, you're not necessarily a fiduciary all the time. You may have to be that in certain circumstances. For us, we like to make it simple. Are you a fiduciary all the time, working in our best interest? Compensation is separate from that. So there's a category called fee only, which actually Erin and I are both fee only, which means we only get paid by our clients. Someone wants to work with us or a firm like us, we say, we work for you. Here's our fees. This is how it's going to work. There are other arrangements where you may be compensated by a product you're selling. You may say, hey, client, I still think this is a good idea, but I want to put you in this mutual fund. And then the mutual fund is actually paying the advisor on the back end. It doesn't mean it's wrong. Doesn't mean they're doing anything illegal. It just, personally for me, I think it may cloud someone's judgment, but there's nothing illegal or wrong about it. It's just how part of the industry works. So some are paid on compensation. Some may get referral fees. If you're working with, again, like an insurance agent, they are actually selling you some type of product. You start paying the premiums on that, and they're being paid through kind of the insurance company. So it's just important to kind of know who you're working with, like exactly who are they working for? Are they working for you? How are they being compensated? Again, those other arrangements aren't necessarily wrong, but I just think we think it's important to know, like, how are you being compensated? What exact services are you offering us? Are we doing comprehensive financial planning, or are we working on my insurance with some investments sprinkled in? So I hope that clarifies it. I know it's confusing. It's partly by design, by the industry in some ways. But it's just questions to ask whoever you're working with or consider you may work with.
Thank you. And so tax planning is also a big part of many people's concerns, or about, how they plan for their future and what are the tax impacts. So I always think of CPAs, certified accountants, as people, thank you, as people who help you with taxes. But do CFPs also play a role in helping advise you about what the tax implications of specific investments or decisions would be?
Yeah, the short answer is yes. Is a CFP, is a financial advisor, even at my firm, we have to have knowledge of tax implications. Now, my firm, or I personally, do not prepare any clients' tax returns. They have their own CPA or they do it themselves, but it's important for your advisor to have knowledge of tax impacts of certain investment decisions, or, I mean, I would say generally in my world, that's like what I'm thinking about a lot, but then also just how taxes generally kind of impact your long-term financial plan. But a certified financial planner or financial advisor doesn't have to know the ins and outs of the ridiculous IRS tax code, right? That's the CPA's job. But I will say that, you're a financial planner. If you're doing one, you're working with someone doing comprehensive financial planning, it's corny to say, but they really should be like the quarterback and engaging with your CPA, maybe your estate planning attorney, for example. But just having a sense of all of the different components.
Another question. Is it prudent for an older adult to use their certified financial planner and give them power of attorney and executor authority for themselves.
We don't do that. When it comes to estate planning, it's super important. Especially if you may be in the later stages of your life, having a will, having a living will, healthcare proxy, power of attorney. It's really important to get that tightened up. One of the things we do is we make sure that our clients have that. It's up to date. You know, if they move states, it may be important to get new documents made or have them looked at. But we do not want to be in any of those documents. I guess I don't have opinion if you could be. It depends on your relationship. I think it may cloud things a little bit. But we don't engage in that. Erin, do you?
No, we don't know. I mean, that's not to say that there aren't planners that do that. But again, that's something, you know, if you do need that type of service, you know, certainly asking that question when you're interviewing.
And then sort of sticking with some of the tax questions. So various bonds are tax-free at a federal, state, and local level. When you're even thinking about your mix of stocks and bonds, and you had some very valuable charts showing, depending on your age and where you are, you might want to have less risk or more risk. Are there reasons to choose tax-free bonds or not choose tax-free bonds? Because obviously some of them are tax-free. So you would think, whoopee, that's the one to go for. But there must be reasons people don't choose tax-free.
So that's another thing too. I mean, like, where your financial advisor should be knowledgeable of, you know, tax implications of various investments, because it's something it's called asset location. So where are you putting specific investments? It doesn't make sense to have tax-free bonds in a tax-free account, such as an IRA, right? It's better to put those types of tax-free investments in your brokerage account or anything that you are paying income tax. And, you know, I also think too, you know, corporate bonds, again, it depends on the risk. You know, yes, you're paying tax, but the after tax return based on your income tax rates could be higher, you know, if you bought that versus just a tax-free bond. So I think bonds are so complicated and nuanced, many different factors. But again, that's like where I think working with an investment professional and someone who has general knowledge.
Yeah, and I'd also add, like, so municipal bonds pay a lower rate than, say, corporates or even treasury, because you're getting that tax advantage. And there's kind of a break-even formula. So in general, just a rule of thumb, municipal bonds are usually better for people who have higher incomes. If you're not paying a lot in taxes already, municipal bonds may not be a good choice for you, because you're getting inferior rate versus alternatives. So it's just something to consider. That, like Erin said, this is where taxes play an important role, where your planner should, you know, be getting your tax return each year. They should have a very good idea of kind of what tax bracket you're is. They may not be filling out the tax return, because that's a whole nother ballgame. But they've got to know some of the basics of your tax status and where those positions are going. So also, just to reiterate, because I think I saw a question there, someone said, would you put municipal bonds in like an IRA? Generally not, because everything coming out of that is going to be taxed at regular income levels. When you want your municipal outside of that, where you're going to get that tax advantage. But again, it makes more sense when you have a higher income, and that's relative to everybody. It's really hard to comment in general, but it's just something to think about.
Got it. So here's some terms I didn't even really know. What is a gold IRA?
I don't think there is anything. Maybe someone's talking about putting gold in an IRA.
Oh, I don't
Maybe,
know.
yeah.
I thought you gave them to Menendez. I'm sorry. Oops.
He's
You
got
let
one.
the Menendez
Yes,
family
he's
hold
got
your
one.
gold bars for you. Okay, so
Yes,
we're not
gold
sure there's
bars.
a gold IRA.
I mean, there are gold investments. There's gold ETF. You can have gold in your IRA. Perhaps that's that's what they're getting at, but I'm not familiar with the term gold IRA. No.
Fine. And
Okay.
then explain to me about what are ETFs and how do they differ than, say, other investment stocks and bonds?
So, yeah, and like we will be circulating I wanted to be careful not to just get too granular on that one particular slide, but an ETF is traded like a stock. So if you, I guess, more simplistic, an ETF is essentially a basket of securities. So you could buy an S&P 500 ETF. Their common one is SPY, that's the ticker. That owns basically every company of the S&P 500, and it's just tracking that index. And that is, like we're again talking about, you get instant diversification within, let's say that's the US large cap space versus buying an Apple, a Netflix, right? And those again are traded ETFs like a stock. So if I right now put it in order to buy an ETF, it's going to be executed at whatever price it's trading at in that moment. Mutual funds are a little different. It's essentially the same basket of any particular type of security or theme or what have you, but those are valued at the very end of the day. So basically, I could place an order for buy a mutual fund now, and Ed in 4 hours does the same thing. Both of us are going to get the same price at the end of the day. And those are, like I said, different from buying individual companies or government securities.
Great, thank you. When I was looking up ETFs in advance, I came across a book, ETFs for Dummies. I chose not to buy it right away, but it made me realize, oh, they're actually a little complicated. So thank you. We didn't talk at all about annuities today, for the idea of investing for older New Yorkers or for planning for retirement. I know there's been some controversy around them. Do one of you want to talk to me a little bit about the pluses and minuses, perhaps, of exploring annuities? Another one that needs a book for dummies. Okay.
So yeah, the annuities can take a lot of different forms. There's an immediate annuity where you buy it right away. Say you give $200,000 and it'll pay you, depending upon the interest rates, it's going to pay you this perhaps for the rest of your life. So you can guarantee that you at least will have this payment. There's another type of annuity where you're buying in for a certain period of year, and then it gets turned on. There's newer products now that have links to the stock market where you can get a certain amount of upside and perhaps cap the downside. In the past, I think they had a bad name because they can get complicated. There could be large fees embedded in them. Our personal philosophy is we don't really get into annuities. It doesn't mean there's anything inherently wrong with them. It just at my firm, the more investment philosophy is you have a portfolio to manage, and we're going to manage that appropriately throughout your life, and we're going to manage what you can take out of it. And at the end of your life, you may, if the goal is to spend it down, we're going to try to do that. But for most people, they want to keep a nice cushion, and those are your assets. A lot of times with annuity, it's gone. There may be certain mechanisms to get part of it back if you don't live so long. It may just be a piece of your financial plan. And there's a lot of kind of literature coming out recently saying, like, annuities may play a greater role. The fees have come down. I'm not an expert in annuities, but that's, I guess, maybe like kind of high level the way I see it. Erin, do you want to add anything on that?
No, I think you covered it. I'm not an expert either. I just think it's with any product, whether it be an investment product or an insurance product, an annuity, just understanding the fees and the costs associated with them is really important.
Yeah, this goes back to just the comprehensive financial plan and who are you working with. So if someone's recommending annuity, are they selling that to me? How does that affect my goals, my overall cash flow? Are we doing comprehensive financial planning here, and you're recommending annuities a component of that? Because that could be perfectly valid. If it's just like, oh, I've got the perfect thing for you, you need to put all your money in annuity, Okay, let's start asking those questions. How does that fit into everything else we talked about? What services are you providing for me? Are you a real planner, or what's going on here? Maybe perfectly valid, maybe a great choice for you, depending on your circumstances, but just want to make sure that you know it fits into the overall picture in a beneficial way and you understand what's going on.
So we all know that, the smart planning angle is to start as young as possible to save as much as possible towards retirement. But reality isn't always that story. So these are questions about starting fairly late as an older person to start investing. So I'll just sort of read 3 of them together. How do you catch up as an older adult if your retirement funding is not where it should be? We usually hear about securing what you've got now, not necessarily trying to maximize current conditions to make up for lost time. And is there any point in investing $10,000 to $20,000 at the age of 80? And if so, what would you invest in? And then finally, sort of on the other end of the scale a bit, what would you recommend if you are down to your last 500,000 of retirement savings? I suppose the person with 10 to 20,000 would think 500,000 would be a pretty good storyline. So you're later in life, you don't actually think you put away enough. What should you deal with now? Where should you start?
You want to go first?
I mean, I think, and this is a common question, and I certainly in no way there want to shame anyone that, you didn't
No.
say whatsoever, and because there are circumstances in life that, is it more important for you to maximize the income coming from your paycheck because you need to pay rent, you need to buy food, versus putting it away for retirement? I think just generally putting away whatever you can, whenever you can. Obviously, someone who is starting much younger does have the benefit of time. But I don't think I think what you can, whatever you can put away now, do that. There are also, for if you're over a certain age, what are called catch-up contributions. So with an IRA or a 401k, for example, you're limited, you're maxed out. But I think if is it at 55 or 65?
Over 50 catch up?
Yeah, the over 50, yeah. So you can add a little bit more if you can now afford to do so. I mean, if you're down to your last 500,000, again, I think just budgeting and goal setting there. I mean, certainly living within your means is important. And I don't know. I mean, those are more conceptual.
It's hard to answer a question like this because there's so many different circumstances. How old are you? Do you have other income sources? Do you own your home? What are your monthly expenses? Do you have a spouse? Do you have kids who may take care of you, or parents or others? I guess I would caution if like I think you use the term like makeup, or like if someone has a limited amount of money, I wouldn't say, okay, now is the time to take as much risk as I can in the stock market in hopes of trying to make this up. I guess the general advice would be, yeah, perhaps look for some guidance and like look over this may require cutting back. It may require looking for family for help. It may require a lifestyle adjustment. It's really hard to kind of answer the question because everyone's circumstances are so specific.
Right, I agree. It's very hard to try to answer those. That's why I sort of combine them all, seeing if some themes came out of it. Oh, quite a few of these. So let's talk about socially responsible investing and wanting to make sure you're investing in sustainable investments while not supporting fossil fuels or other climate change, damaging stocks. I know in my work as a senator, I keep pushing government not to use pension money for oil and gas stocks because we want to get everybody out of oil and gas as fast as possible. And I keep getting told by people who run pensions, well, actually, oil and gas stocks are doing pretty well. And I'm like, yeah, but we're still destroying the world. and they're counting on wars to make money for them. So I'm not sure I really am excited about that either. So what do you think? And I know there are green investment models and all kinds of social investing now. What kind of advice do you give people where that's a priority for them?
I guess I'll start with this one. So yes, there's been a big movement in what's called ESG or SRI the last 5, 6, 7 years. There's lots of ETF or mutual funds that have the term socially responsible investing or kind of green. ESG is environmental, social governance issues, meaning they're going to take these a lot more serious. A lot of the way those are managed is they kind of screen out certain things. So they say, this is not going to have any oil and gas, or this is not going to have any guns or coal or private prisons, or some don't want tobacco. It's a kind of a tricky area because there's also a term called greenwashing, where certain funds have kind of slapped on this label because they want to look good, although they're not doing great work there. There's also I've heard some fairly compelling arguments about, especially in Europe. I think Europe's a little bit further ahead than we are in the US. There are certain oil and gas companies there that may be doing a lot of investing in wind farms. So they say, okay, well, you're going to screen out this company, but this company is actually leading the transition over here. So it's tricky. I guess this is an area I'd say I want, if it's really important to you, I would want to search out someone who specializes in it, who can kind of design a certain portfolio around for you that really is in alignment with your values. Because just buying one old green fund versus the next, I have a client, I've done a lot of research for her on this, and these screens are very subjective. So she didn't want any gun companies. Perfectly reasonable kind of request. And I started digging, and some of these screens would screen out movie companies because they had guns in the movies. Well, okay, I don't know if she wanted to go that far. So there's all these different levels. And I guess my advice would be like, this is kind of a specialty I would want to seek out, who someone who really digs deep in this area. Erin?
Thank you. So because we are living in a very unstable political climate, both in this country and certainly internationally, is there some advising about changing investment strategies because we are now in such a challenging and unstable time? I don't know if we ever have stable times, but this definitely feels like it's a bit more unstable.
I think this is the, going back to Ed's mindset discussion, good investing should be boring. And yes, the times are very unstable. If you have aligned your investments and your asset allocation with your time horizon and your goals, I think it's more important to sort of to stay the course and not check everything every day, going in and out of different things. It's so hard to time the market. And I think depending what's going on in the world, I think so much of the risk is that headline risk. That's that's what really is causing volatility. Any unexpected event, a war. So I think just kind of staying invested, and obviously if you are closer, if you are in retirement or approaching retirement, certainly while equities, the stock markets are volatile, and I'm sure going into the elections, we will continue to see volatility. If you need access to that money to live, don't have it all in stocks. I think that's just my general advice. And the long-term direction of the market is not determined by any one elected official. It might seem in the very short term, it's scary. But just thinking, selling all of your investments and just staying in cash is risky in and of itself for the long term. So, and I don't know if you have anything to add there.
Yeah, I would just say, like, what you're basically, or maybe the question's getting at is like, should I get in or out? And that's called market timing, where you're trying to anticipate what's going to happen and then how the market will react. Because even if you knew the future, sometimes the market doesn't even do what you would expect it to do. So that's very risky to get in and out. Our general philosophy is you stay in and you let your money compound. Through the last presidential election, I saw a study done that went back and looked at the history of the stock market and depending on which party was in the White House. And believe it or not, it was almost dead even on the returns. It was a slight advantage for Democrats, but it was not one way or another, which basically means like if you believe in the majority of your portfolio will be in U.S. Investments, if you still believe in our country and the innovation and the research we do, and that companies will advance, think about that as opposed to just maybe what one election is going to do. As long as we still have stability, with that study, you could argue maybe one party have to keep cleaning up the mess of the other party and what they've done, but it's still pretty even across the last 90 years or so.
Got it. We just have time for two last quick questions, but I think they're important. So you're busy saving for your retirement and you've got in retirement accounts, but you're also got credit card debt. Should you be taking money out of your retirement accounts to pay off credit card debt?
So it's funny, I work with a couple 401k firms, and we do the annual 401k for the education events for the employees, and we are, I'm certainly of the mindset, I mean, if you touching your 401k, it should really be your last resort. If you have no other funds, and again, depending what your credit card debt situation is, but I mean, your retirement accounts are tax deferred, and you want to leave them alone to grow for as long as possible. So I certainly think, depending on, I don't want to say it's a hard and fast no, absolutely don't touch them. But instead maybe potentially scaling back your contributions for a time so you have more money to pay, start paying down your credit card debt, versus touching what's in there. But I don't know if you have any other. That's a personal opinion, but again.
Yeah, credit card debt is by definition not good debt. A debt for a house may be what we consider good debt, depending on the rate and your circumstances, but that's an asset that should outlive the liability. Yeah, even paying for higher ed, which is expenses of it may be, you're investing in what we call human capital. Credit card debt, it may be an emergency situation, you had to tap that. But by almost most measures, it's usually bad debt. Whatever it paid for, it's been consumed and it's gone. And now all you've got is this liability that you've got to pay. And credit card debt rates are usually really elevated, 17, 18, 20%. So I would say do whatever you can to get that paid off as soon as possible. Maybe that's reducing whatever contributions you're making to your 401k, as Erin said. Maybe it's changing your lifestyle temporarily, or taking a real hard look at where your money is going now. If you're below the age of your 401k at 59 and a half, you're going to pay a penalty. So that's something to consider. You're going to get hit with a 10% penalty. It may not be worth it to take money out of there now, but what can you do starting from today to start chipping away at that? Because credit card debt really is something you want to try to avoid, unless it's truly used for an emergency.
Great, thank you. And then finally, just because it's almost a universal question for people, when do you make the decision about starting taking your Social Security benefits if you're still working and you have retirement savings? Should you just leave it alone and wait out the length of time, or is the math better for you to just start taking it now, as soon as you're eligible?
So go for that. We almost always encourage our clients to wait to 70 if they can, because you're getting an increase after full retirement age. I believe it's 8%. You're getting a guaranteed increase each year. If you're still working, and you're supporting your lifestyle, definitely wait as long as you can until age 70. The break-even point, I forgot, it's somewhere in maybe early 80s. A lot of times clients get, they've been working their whole life, they've been paying into Social Security, and they get there and yeah, they want their money back. But if you can hold off, it's one of the few investments where you're getting a guaranteed increase. So our general advice is hold out as long as you can.
Thank you.
Mhm.
Okay, so we did not get to all the questions. We did not even get into the whole section on trusts and estates, because really Ed and Erin aren't the attorneys, as they pointed out, who set up trusts and estates planning. So maybe we have to have another roundtable on that. But I do want to thank them so much for coming and being here with us, their great presentation, all their great answers. Again, if you signed up for this event today, you'll be getting in a few days a video tape of this, the PowerPoint, and the resource list that was popping up on your screen. I just, again, want to thank you so much for being a true community resource on helping us understand what are very individual and complicated issues. So thank you, thank you. I want to thank, of course, my tremendous staff, without which I could not do anything. And I want to remind everybody, our next older adult roundtable will take place Thursday, September 12th from 10 to 11:30, titled New Technology Designed for Older People. And we're going to be featuring some of the latest devices created with older adults in mind. And there's a lot of them. So thank you all for joining us today. I'll see you at the next roundtable or around in the neighborhood. Take care.
Thanks for
Thank
having
you.
us. Pleasure.